Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Mastering Portfolio Management, a guide for investors in 2024. Ever wondered how to make the most of your investments while keeping risks in check? Portfolio management is your answer. It's the art and science of choosing and overseeing a mix of investments that align with your financial goals. By understanding this process, you can optimize returns, manage risks, and adjust to market changes. In this video, you'll discover the key elements of effective portfolio management. We'll cover diversification, risk assessment, and the importance of asset allocation. Whether you're a seasoned investor or just starting out, these strategies can help you build a robust investment portfolio. Get ready to strengthen your financial future. Understanding portfolio management. Portfolio management is like being the captain of your financial ship. It's all about making smart decisions to manage your investments with care. Whether you're looking to grow your wealth, save for retirement, or achieve other financial goals, understanding how to balance risk and rewards is essential. Let's break down the basics of what makes up a portfolio and why asset allocation matters. What is a portfolio? Imagine your investment portfolio as a treasure chest filled with various kinds of assets. Each piece inside plays a vital role in your financial journey. In simple terms, a portfolio is a collection of investments owned by an individual or institution. These can include stocks. Think of these as tiny pieces of a company. When you buy a stock, you're buying a stake in that company, hoping it will grow over time. Bonds. These are like IOUs from governments or corporations. They promise to pay you back with interest, making them a steady income source. Real estate. Owning property can offer both the chance for price appreciation and income through rent. Mutual funds and ETFs. These pools of money are spread across various stocks or bonds, offering diversification in one package. Cash or cash equivalents. This includes money in savings accounts or short-term government bonds, providing liquidity and safety. Each of these asset classes has unique characteristics, potential returns, and risks. Together, they make your portfolio diverse, like a well-balanced diet. Importance of asset allocation. Asset allocation is like crafting a playlist for your investments. Getting the mix right is crucial. It involves spreading your money across different asset classes to balance risk and return. Why is this important? Risk management. By not putting all your eggs in one basket, you reduce the chances of losing everything if one investment doesn't perform well. Potential for higher returns. Different assets react differently to market conditions. While stocks might soar, bonds offer stability during downturns. Goal alignment. Your asset allocation should reflect your financial goals, time horizon, and risk tolerance. Are you saving for a house in 5 years or retirement in 20? For example, if you're young and have time on your side, you might opt for a stock-heavy portfolio, riding out market ups and downs. Closer to retirement, you might shift towards bonds for security. Think of asset allocation as your investment playlist's balance of fast and slow songs. It keeps your financial party going, no matter how the market dances. Remember, managing a portfolio is an ongoing process, requiring attention and occasional tweaks to stay on track. Types of portfolio management. When it comes to managing your investments, different strategies can lead to different results. Understanding the various types of portfolio management can help you make informed decisions. Each approach has its own set of goals and methods. Let's explore the key types of portfolio management: active, passive, and the distinction between discretionary and non-discretionary management. Active portfolio management. Active portfolio management is all about seeking higher returns than a benchmark index. The goal here is to outperform the market through strategic buying and selling of investments. Key objectives. Maximize returns. Active managers seek to identify undervalued assets or market trends. Risk management. They also aim to minimize risks by adjusting the portfolio's weightings based on market conditions. Common strategies include market timing. Managers try to predict market movements and make trades accordingly. Sector rotation. This involves moving investments between sectors based on economic forecasts. Stock picking. Identifying stocks expected to outperform based on research and analysis. Active management can offer higher returns, but it comes with higher fees and more risk. Do you have the patience and expertise to follow the market closely? If so, this approach could be for you. Passive portfolio management. On the other hand, passive portfolio management takes a different route. This strategy aims for consistent returns by mirroring a specific index, such as the S&P 500. Benefits of passive management. Lower costs. Since there's less frequent buying and selling, management fees are typically lower. Simplicity. It's easier to manage since you're not constantly researching the market. Consistent performance. By tracking an index, you can benefit from overall market growth without the need for active decisions. Investors who choose this method often find it appealing for its stability and lower stress levels. Why chase every market move when you can take a seat and enjoy the steady ride? Discretionary versus non-discretionary management. In portfolio management, there's also a crucial distinction between discretionary and non-discretionary management. Each has its own strengths and caters to different investor needs. Discretionary management. This approach allows a portfolio manager to make investment decisions on behalf of the client without needing prior approval. It's ideal if you prefer a hands-off approach, as the manager acts on the client's behalf. Non-discretionary management. Here, the portfolio manager provides advice, but the final decision always lies with the investor. This is great for those who want to stay involved in the decision-making process. Choosing between these options depends on how much control you want over your investments. Do you want to delegate your choices or keep your hands on the wheel? Understanding these types of portfolio management is essential. Each strategy has its own benefits, risks, and costs. What's your investment style? Key principles of effective portfolio management. Effective portfolio management is a blend of science and art that helps investors achieve their financial goals. It requires an understanding of strategies, principles, and practices. Two key principles stand out in this process: risk management and performance measurement. Let's take a closer look. Risk management. Understanding risk is crucial for anyone managing a portfolio. Assessing risk helps you see what could go wrong and how to protect your investments. Think of it like driving a car. Before you hit the road, you check your mirrors, buckle your seatbelt, and keep an eye on the speed limit. This is about being aware of your surroundings and making safe choices. Here are some key components of effective risk management. Identify risks. Knowing the types of risks your portfolio might face is the first step. This can include market risk, credit risk, and liquidity risk. Measure risks. Use various tools and metrics to gauge how much risk you're taking. Metrics like beta can show how your investments respond to market changes. Manage risks. Diversification is one of the best strategies to manage risks. By spreading your investments across different asset classes, you can minimize the impact of any single investment's poor performance. Review regularly. It's not enough to assess risks once. Regularly review your investment choices and adjust as needed. The market changes, and so should your approach. By continually assessing and managing risk, you create a stronger and more resilient portfolio. Performance measurement. Measuring how well your portfolio performs is just as important as managing risk. Performance measurement lets you know if you're making progress toward your goals. It's like tracking your weight loss. If you don't measure it, how will you know if your diet and exercise are working? To get a clear picture of portfolio performance, consider these aspects. Benchmarks. Compare your portfolio against relevant benchmarks, like the S&P 500. This helps you understand how well your investments are doing in relation to the market. Metrics. Use metrics like total return, which shows the total profit from your investments, or the Sharpe ratio, which assesses risk-adjusted returns. These tools provide deeper insight into performance. Consistent reviews. Just as with risk management, regularly reviewing performance is vital. Set a schedule to evaluate quarterly or annually. Are your investments meeting expectations? If not, what changes need to be made? Adjust goals. As you review your performance, adjust your goals as necessary. Life changes, and so do investment needs. Being flexible is key to ongoing success. Measuring and analyzing performance regularly will put you on the right track. It helps you make informed decisions, refine strategies, and ultimately reach your financial objectives. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.